On a humid Tuesday in March, a small team of 3 operators stood on a cracked asphalt parking lot in midtown Tulsa, Oklahoma, looking at a tired 38-unit apartment complex. Brick exterior, flat roof patched twice in the last decade, 2 boarded windows. Rents were $180 below the local market. The seller wanted $2.65 million. 14 months later, that same building closed for $4.2 million to a regional buyer. The deal generated roughly $1.15 million in net profit after every cost, paid every investor their preferred return, and made each of the 3 sponsors more money than any of them had ever earned in any single year. In the next 30 minutes, we're going to open the deal. Every line of the underwriting, every dollar of the capital stack, every CapEx line, every mistake. Anatomy of the deal. Here is how this episode is structured. The property, 38 units, built in 1973. 2 two-story brick buildings arranged in a U around a center asphalt parking lot. 28 one-bedrooms and 10 two-bedrooms. In-place rents averaging $710 for the ones and $860 for the twos. Comparable nearby Class B+ properties, recently renovated, similar floor plans, same submarket, we're leasing the same 1-bedroom at around $890 and the same 2-bedroom at $1,060. So already the thesis is forming. A roughly $180 to $200 per unit per month rent gap across 38 units, that's a gross potential rent uplift of about $72,000 a year if you can fully close the gap and the units actually release at market rents post-renovation. In commercial multifamily, every dollar of net operating income, NOI, typically trades at a multiple. In this Tulsa submarket, in this time frame, that multiple was a roughly 6% cap rate, meaning every additional dollar of stabilized NOI is worth about 16 2/3 in resale value. Round numbers, every $10,000 of NOI lift is worth about $167,000 of property value. So that's the thesis. Buy the property at a price reflecting the in-place rents, pour in renovation capital, push the rents to market over 12 to 15 months as units turn, restabilize at higher NOI, sell into a market that pays cap rate multiples on that new higher NOI. That is the value add multifamily playbook. This deal is a textbook example. Now, the seller, the previous owner, had held the property for 16 years. Self-managed, local, tired. 2 children in college, a wife with a chronic medical condition. He was, in industry terms, a motivated seller. Not desperate, not distressed, just done. That is exactly the kind of counterparty you want at the table when you're paying for the future and they're tired of the present. Now the money. Because real estate at its core is a capital stack puzzle. Let's walk it from the bottom up. Total project cost, purchase price plus closing plus the renovation budget was approximately $3.05 million. Of that, the senior loan covered $1.84 million secured against the property. The remaining $1.21 million was equity. Of that equity, the sponsor team, the 3 operators standing in the parking lot, contributed about $122,000 total, or roughly 10%. The rest, $1.09 million, came from limited partner investors. 8 LPs contributing somewhere between $50,000 and $300,000 each. The senior loan terms matter. 3-year term, interest only for the first 24 months. Rate of approximately 7.25% fixed. Origination fee of 1%. Prepayment penalty step down over the term. Recourse on the sponsor entity for completion of CapEx, but not for ongoing performance. Why interest only? Because during a value add deal, you don't want to be paying down principal. You want every spare dollar of cash flow going to renovation, lease-up costs, and reserves. Interest-only financing preserves cash for the value creation phase. You pay it back through the eventual sale or refinance, not from monthly operating cash flow. The LP investor terms. 8% preferred return. That means the LPs get the first 8% of annual cash returns on their capital before the sponsor sees a dollar of profit. After the 8% pref is paid in full, profits split 70-30 in favor of the LPs, up to a 15% total internal rate of return. Beyond that, what's called the promote, profits flip to 50-50. This structure does a few things. First, it aligns the sponsor with the LPs. You only make real money if your investors make real money. Second, it gives the LPs downside protection because the 8% pref means even if the deal performs okay but not great, they get paid first. Third, it rewards the sponsor disproportionately for excellent execution. In this deal, that promote structure is going to matter enormously because the deal blew past the 15% IRR hurdle. Now the construction side. Total renovation budget, $610,000. That breaks down into three main categories. Let's go line by line. Flooring, $2,800 per unit. Luxury vinyl plank throughout. No carpet anywhere except bedrooms in a few units. LVP has emerged as the industry standard durable flooring for value-add multifamily because it's water resistant, dent resistant, and survives the kinds of move-ins and move-outs that destroy carpet within a year. Cabinets and counters, $2,200 per unit. White shaker style cabinet refacing, not full replacement because the existing boxes were structurally sound. Quartz look composite countertops, which photograph indistinguishable from real quartz at half the cost. This is one of the highest ROI line items in the entire budget. A renter walks into a unit, sees clean white cabinets and a stone look counter, and immediately upgrades their rent expectation in their head. Appliances, $1,800 per unit. Stainless look range, dishwasher, and microwave vent combo. Refrigerators were kept from the existing inventory if they were under 5 years old, replaced if older. This saved roughly $15,000 across the project. Paint and trim, $1,200 per unit. All walls, one consistent warm off-white. Trim and doors, a high contrast soft white. Boring decision, but consistency across 38 units significantly reduces turn time on every future tenant transition. The team also added a single accent wall color to the living room in each unit, which photographs beautifully for the leasing listing. Fixtures and hardware, $900 per unit. Brushed nickel lever door handles, matte black ceiling fans in living rooms, new LED bath vanity lights, updated kitchen pendants. Small individual line items, large cumulative perceived value impact. Plumbing and electrical, $1,200 per unit. Mostly servicing rather than full replacement. New toilet flappers, fresh wax rings, updated angle stops, GFCI outlets in kitchens and baths. Some kitchen sinks and faucets replaced were heavily corroded. Boring, defensible work that keeps the property out of code trouble for the next 5 years. Exterior and common area, $130,000 total. Roof patching, not full replacement. Repainting trim and shutters. Parking lot seal coating and restriping. New signage at the entrance, replacing the faded Midtown Oak apartment sign with a clean, modern monument sign reading Oakwell, Tulsa. Updated mailbox kiosk. New leasing office furniture and signage. One key choice on the rebrand. The sponsors changed the property name from Midtown Oak to Oakwell, Tulsa. That single rename was deliberately designed to break the property's online reputation tail. 18 years of mediocre Google reviews, 3 Better Business Bureau complaints, and a Yelp page full of pictures of broken down units, all attached to the old name. A new name plus a fresh listing with renovated photos lets the property rebuild its online identity from zero. Major systems and reserve, $80,000. HVAC compressors for the units that were marginal. Water heater rotation. A solid reserve buffer for the surprises every renovation produces. On this deal, the surprise was a partial sewer line collapse in Building 2 that ate $41,000 of that $80,000 reserve in a single week. Without the reserve, that line item would have come straight out of investor equity. Always carry the reserve. Always. Operations during the value add phase are their own discipline. Two things drive everything: occupancy and rent capture. At purchase, the property was 87% occupied, 33 of 38 units leased, at average in-place rents well below market. The team's lease-up strategy did not try to push existing tenants out. Existing leases were honored to term. As each lease expired, the unit was inspected. If the tenant was paying close to market and wanted to renew, they were renewed at a modest bump. If the unit was significantly under market, the tenant was given a friendly non-renewal notice and the unit was scheduled for full turn. Each turn unit was renovated within 7 to 10 days. The crew rotated through buildings in a coordinated sequence. By the end of month 9, 22 of the 38 units had been fully renovated and leased at new market rents. By the end of month 12, 33 of 38 were renovated. The remaining 5 were occupied by long-term legacy tenants on lower rents who chose to renew and were strategically retained because vacating those units would have hurt occupancy at the worst possible moment heading into sale. Average rent capture on the renovated units. One bedrooms released at an average of $885, within $5 of the team's underwriting target. Two bedrooms released at an average of $1,035, $25 below underwriting target. Across the full restabilized rent roll, the team captured approximately 86% of the available rent gap. In value-add multifamily, anything above 80% capture is excellent. Operating expenses also dropped. The team brought property management in-house with a third-party fee-based operator, replacing the previous owner's reactive self-management. Insurance was rebid, and despite the regional rate environment, the renovated property qualified for a slightly better tier. Utility leaks identified during renovation were patched, knocking water expense down by roughly 12%. These small operational wins, in combination, dropped operating expenses per unit by about $600 per year. Now the exit. Because every deal is just paper until you can monetize it. At month 12, the team began quietly marketing the property to regional buyers, small private equity funds, and 1031 exchange buyers from California and Texas who were hunting for stabilized Class B+ value-add product in secondary markets. The listing broker was a local Tulsa multifamily specialist who had brokered 4 similar deals in the same submarket in the previous 18 months. Final sale price, $4.2 million. Buyer, a regional fund based in Dallas with a portfolio of similar Class B+ Oklahoma and Arkansas properties. All cash offer. 14-day diligence, 30-day close, no financing contingency. The sale price math. Stabilized NOI at sale, approximately $252,000 per year. Sale cap rate, 6%. $252,000 divided by 0.06 equals $4.2 million. The cap rate math, executed correctly, is one of the cleanest valuation methodologies in real estate. You earn the lift by improving the NOI. The market rewards you with the multiple. 2 things to flag, honestly. First, the team caught a favorable cap rate environment. If interest rates had spiked another 100 basis points during the hold, the exit cap could have been 6.5% or 7%, which would have shaved roughly $300,000 to $700,000 off the sale price. That risk was real, and the team knew it. Second, the deal could have been refinanced rather than sold. The team chose to sell to fully crystallize the carry. In a different rate environment, holding and refinancing into long-term debt would have been the right move. Each cycle has its own playbook. Now let's walk who got paid what. Total equity at start, $1.21 million. Net proceeds back to equity at sale, $2.175 million. Gross equity multiple, approximately 1.8 times. Net IRR after pref and promote distributions, approximately 58% annualized across a 14-month hold. Walk it carefully. First, the LPs are returned their original $1.09 million in capital. Then they receive their 8% preferred return on that capital, prorated for the 14-month hold, approximately $102,000. The remaining $983,000 flows through the promote tiers, 70-30 to the LPs, up to the 15% IRR hurdle, then 50-50 above it. When the math settles, the 8 LPs collectively walk away with about $1.69 million, a 1.55 times multiple on their investment in 14 months. The 3 sponsors split approximately $485,000 on their $122,000 of sponsor co-invest equity, plus their share of the promote. Each sponsor cleared roughly $160,000 of personal proceeds, more if any of them deployed a larger share of the sponsor stake. No deal is clean. 3 honest mistakes the team made on this one. Mistake 1. The renovation reserve was sized for cosmetic surprises, not infrastructure surprises. The partial sewer line collapse ate half the reserve in a week. On future deals of this vintage, this team now carries a separate $20,000 dedicated underground systems reserve on top of the cosmetic reserve. Mistake 2. The team waited too long to upgrade the leasing office staffing. The first 3 months relied on a part-time leasing agent inherited from the previous owner who underleased the renovated units at slightly below target rents. By month 4, the team hired a dedicated full-time leasing manager and rents tightened to target within 30 days. On future deals, full-time professional leasing staff is in place from week 1. Mistake 3. Selling rather than refinancing. This one is more nuanced. The sale was a great outcome in absolute dollars, but long-term, refinancing into permanent debt and holding for a 5 to 7 year stabilized run would likely have produced superior total returns through compounded NOI growth, principal paydown, and avoiding a second taxable event. The team chose certainty over upside. Reasonable, but worth naming. That is the anatomy of a $4.2 million Tulsa apartment flip. 1 38-unit Class C building. 14 months of disciplined renovation and operations. $1.15 million of net profit. An 8 LP investor group made 1.55 times their money. 3 sponsors cleared roughly $160,000 each. All from the boring, methodical, repeatable application of the value-add multifamily playbook. Future episodes of this channel will go deeper. We'll do larger deals, smaller deals, deals that failed, deals that were saved, different markets, different asset classes, different capital stacks. But the structure of every episode will be the same. We open the deal. We show you every number. We name every mistake. Anatomy of the deal. If you want to see real numbers on real deals, subscribe. We're just getting started.